Good afternoon, everyone. Thank you for coming. We are in a much bigger class today, I think, so we're a little bit more dispersed. Welcome. And today we're going to talk about climate. So the first thing I will say is that I do not have all the answers to what we're going to talk about today. In fact, I have, many thoughts. And what I'm looking for is really quite a lot of interaction, more than we've had in the last couple of sessions, in a way, because I'm very interested in hearing your views and your thoughts and how you think we should think about some of the issues that come up in the next slide. So there's no right, wrong answers, but I'm really looking forward to your contribution as well, because as I said, I don't have all of the answers. So I'm just going to do a quick recap of what we've talked about, okay, for the last two sessions and today. So in terms of themes in what we've done, the first session, we looked at preparing for the known unknowns, okay? So what was inevitable, hard to predict events at a micro level, meaning we looked at the counterparties, we looked at what we knew we could see, or we should have seen, we should have known looking at the counterparties and the weaknesses in underlying transactions or clients, and therefore we could prepare for what we sort of knew but didn't know when it would happen. The session we looked at then on Tuesday was looking at the unknown knowns, meaning things, events that were avoidable, easy to predict. So, for example, if we recall the Korea examples, if we had looked at the data that was there, if we had looked at the level of indebtedness, if we looked at the environment, it was all there, very clear to see. And these were risks and weaknesses that came from the market environment that we should have probably been better prepared for. What we are going to look at today, in my mind, in climate risk is really the unknown unknowns. We know with a high degree of certainty that the event will happen. We don't know when the event will happen, and we do not know the intensity of the event. And today, as we speak, we are unable to quantify that intensity of the impact. And we don't know when it will happen, as I already said. So it's a very different type of risks. We know that it's there. We know that the regulators are pushing the banks to implement this financial risk, climate risk as a financial risk, but it's very difficult to quantify. And then I'll come to how I think about this, okay? So I'm going to just put that up for 1 second here. And can I just stop here in terms of these three summaries? Anybody would like to say anything about, the sort of like the quick recap that we've just had? Any comments, any questions before we go into the detail of climate? Any observations or any other questions that you would like to ask from what we've covered in the last couple of days? No? Okay, so I'm going to go straight into I can send you these little cartoons. I think they're quite interesting. The complete denial of climate risk and actually what happens afterwards. But so when we think about climate risk, and you've obviously all of us, we've heard quite a lot about climate risk in the last few years, a couple of years or so. If you look back more than 2 years for sure, climate risk was approached through, actually, we'd not even heard of climate risk. All we heard about was climate change. It was approached through the lens of corporate social responsibility, mostly in whether you're a bank, whether you're a company, and looked at from a reputation perspective. Basically, the corporate citizen responsibility was at safeguarding the reputation. Lots of activism from NGOs, lots of pressures from the NGOs, hardly any requirements around disclosures, and as I said, no designation as a specific risk types. Fast forward now to 2019, you obviously have a very different change in the environment. And if I can just start in that perspective is, at the moment, the way that I see it or I think about it, and please, as I said, interrupt me, interject, and tell me that you don't agree, as I've asked you before. But I think there are really two schools of thoughts on climate risk, okay? One that says that climate risk is broader than sustainability, and I know Luigi and I had an interesting conversation yesterday about sustainability versus climate and how does it relate to each other. But for me, climate risk is, well, two schools of thought, first of all. Climate risk is broader than sustainability, and the other school of thought that says that climate risk is only one element of sustainability. So I'm a risk manager, so the way that I think about it is that climate risk is broader than sustainability, because as a risk manager, if you want to approaching it from a risk perspective, I separate my thinking in two parts. One is the contribution to climate change as an organization, whether you're a bank, whether you're an oil company, whether you are a corporation, doesn't matter what your business is. So what is your own contribution to climate change? And two, what is your exposure in your business as a result of climate change, okay? So that is how I look at it. And when you think about the Paris Agreement that has come in, the understanding and assessment of the financial risks that arise from climate change, not just in a broad perspective, but in your day-to-day basis, the requirement to integrate climate risk within strategy and risk appetite articulation, whether you're a car manufacturer, whether you're an oil and gas company, or whether you are a bank, and especially if you're in a bank in the last recent 12 months or 18 months, that is key. We are also required now to applying a far longer term lens, to look at what these risks might be, and having a much longer planning horizon to demonstrate that understanding. And we are also being asked to implement and monitor regular updated metrics to monitor those risks that come from climate change. And we've all heard about the scenario analysis to support that risk assessment. So I'm going to pause here for a minute, right? And we're going to just look at all this in the different parts, and we're going to go into the specifically the two parts of risks that come out of climate risk. But just thinking about this historical context and the fast forward to 2019, do you guys have any views, any observations? You know, how do we think about what do we mean about implementing or integrating climate risk in strategy? You know, what is it that we would need to do in order to basically set up? Because you remember what we talked about in the last couple of days. We talked about credit risk, market risk, right? All these type of risks, they have specific risk frameworks in place. Climate is new. There's nothing. We've got to create a climate risk framework to manage climate risk. How do you guys think about this? Or how would you think about it? Or how do you think about it? Give me some inputs.
There are things like weather derivatives, climate derivatives.
There's been weather derivatives in place for quite a while. They're not very liquid, but they have been simply based on nice derivatives traders trying to find funky products as opposed to thinking about climate risk, not relating to specifically managing climate.
I guess one question, lots of other forms of risk aren't sort of as necessarily or inherently political as talking about climate risk. I.e., there's direct risks that a corporation might face as a result of climate change that it needs to plan for in critical part of risk planning. There's also plenty of organizations, be they regulators or nonprofits, that would very much like corporations to acknowledge and talk about the risks of climate because it serves a broader and probably very necessary political agenda. And I guess as a risk manager, how do you think about pulling those two things apart with climate as opposed to, say, conventional weather risk or some other risk?
Yeah, that's a very good observation. And one of the things we'll see in the following slides, how the policy risk, if you want, should absolutely factor, I mean, the way that I've looked at it. And by the way, whatever you see next is my own thoughts on how to manage climate. Somebody else might be thinking about it differently at this point in time. But yes, I think policy is a key one. And we'll come in the examples afterwards. Anything else? What do you think about strategy? So when we say, if you think about it, that you're sitting in front of you are the business guy. You are sitting in front of your client, and you've got to think about, I'm going to do my client planning, and I've got to think about climate risk just as much as I think about what product am I going to plan for this guy for the next 12 months. What does he need or she needs? How do you bring climate into strategy? How would you think about that? Anybody? Are you thinking about growth in sectors that are being impacted by climate? Are you talking to clients? Are your clients, exposed to climate risk in a way? So these are the things that we now need to think about. Okay, nobody required banks or, companies, probably oil and gas companies probably definitely thought about this, but banks have to think about this. Banks are going to have to define a risk taxonomy. How do we differentiate about, if you think about counterparties, they are rated. So external rating, you have an understanding of, if you're looking at a counterparty who's got a AAA rating, let's say from Moody's or S&P, and a single A rating, you can understand the difference in the riskiness, the riskworthiness of that counterparty. There's no such thing that exists for climate. So risk taxonomy is going to have to be defined, to be able to differentiate between the risk levels. So any thoughts about how would you look at making that differentiation in terms of risk level for climate? What would you look at? What do you think? Again, I'm saying I don't have all the answers. I can tell you what I think. I'm trying to also get some thoughts from you guys. What would you think of?
So I guess I was looking at the second bullet, so looking at the financial risks arising from clients. So in a retail business, like in a mortgage portfolio, could potentially look at the geographic concentration and the exposure to like a hurricane. So I'm thinking of like Sandy, for instance, on the East Coast.
Yeah, absolutely. Contribution to CO2 emission, like what is the industry you are wanting to bank? I mean, if you look at a growth strategy in an obvious one, obviously, but oil and gas industry, obviously you're going to be contributing to the CO2 emission. Should you be thinking about, doesn't mean you don't do business in that sector anymore, it's just how do you think about doing business in that sector while thinking about the CO2 emission impact, okay? Now, for me personally, I'll tell you, when I've looked at this and trying to put a risk framework for my own organization, the one that I struggled quite a lot with, the two things actually, is really thinking about the metrics. So it's very difficult to come up with metrics given what we said at the beginning. We know it's going to happen, but we don't know when it's going to happen, and we don't know the intensity of what is going to happen. But you've got to start somewhere. So you've got to be able to find something that you want to try and monitor maybe the performance of identifying, as you just said, which segment of your portfolio is in certain segments of climate events, and monitoring that the performance, or so you've got to. There's no precise answer to that, but I found it quite challenging. Scenario analysis is another one, but before I go to that, is the tenor for me that I've challenged, and I don't really have an answer to, because I think it's very tough to look forward. So how do you look forward into what will be climate risk or climate event that will result in climate risk in a 5-year horizon? It's very difficult. How do you quantify that potential intensity? So for example, we could then link it to scenario analysis, where we can say, I'm making it up now, but let's say, for example, New York, which we know is a city which is prone to sea level rises, and we say that the economic activity of New York is going to decline by, I don't know, making it up, 3% because of climate event. May not happen, but that's the assumptions you've got to make, and you will have to make decisions based on those scenarios that, you haven't got back data to really look at it. You don't know whether it's going to happen. So I think, again, my view is that having various scenarios, different sort of, possible outcome, and that you then have to make a judgment on, I think is key. And if you remember the first day I said to you, risk management, for me, there's no science behind risk management. You look at a bunch of facts and you make judgment calls. Well, here you've got a bunch of facts that you don't really know, the past. You don't know you do know the past when it happened, but you can't predict exactly when it's going to happen. And you definitely do not know the future, therefore the facts are a little bit loose, but then you've got to make a bunch of judgment calls on things that you're not quite sure about. Okay, anybody wants to make any other comments on that? Any views from the professors? Observations? The wisdom in the room? Okay. So one of the first tasks that I was given by my boss in my job on climate about 2 years ago, I think it was, or 18 months ago, was define climate risk. And the first thing that I thought of is, how am I going to define this? When you talk about climate, there's a lot of people who sort of look at you and think, well, are you talking about hugging trees? Are you just talking about, well, the icebergs are melting and therefore sea level is rising? What is it? How am I going to define it? Because one of the big challenges is to sort of think about climate change and translate, and all the sort of geophysical, technical words or way of describing things, and translating this into into the language of business. And I personally, I've found that quite challenging, because it's very difficult to get business people to understand. Because all they want to know is, okay, what do I do? How do I do my next deal? That's what I want to know. So how do I think about this in terms of, I'm going to go sit in front of my client. What do I tell them if I have to think about this? And the interesting thing for me when I sat back and I thought about it is that climate risk is one of these that touches absolutely every type of economic players and sectors of the, across, whether it is governments, whether it is companies, whether it is banks, households, and the level of interconnectedness between climate risk and the other risk types that we talked about in the last couple of days, credit risk, market risk, operational risk, I think is very big, and climate risk manifests itself through those risk types. So, if you have a counterparty default, it's credit risk. If you have market risk events, it's a market risk. If you've got an operational issue that has happened because your collateral has gone in a different place, or you've released a payment that you should not have, it's an operational risk event. There is nothing that happens that is climate risk. Something happens which is a climate risk, and it manifests itself through one of the risk types that we've been talking about. And so when I sat back and I thought about this, I thought the way to communicate climate risk in my mind is that climate risk is irreversible compared to other risk types. So if you've got a credit risk event, you can recover. You can go after your client and you can try to restructure your deal. You can try and, beat up the table and tell them that you're going to take their hotel in the middle of Red Square, even though you think you don't, but they're going to, hopefully give you your money back. But with climate, you can't change the event. It is irreversible, okay? Market risk, volatility will eventually level out. Operational risk, you look at what went wrong and you change your operation manual, and you change the way that you've been operating. So that's the key thing, okay, for me, for climate risk. Do we get that, what I mean, or do you agree with me? Yeah.
I mean, that seems like a really helpful framework. It seems like you also have on your slide the physical risks and transition risks. So I was also thinking about it in that context. seems like some climate-related consequences could be reversible. So you have physical risk, right? My factories are destroyed by a hurricane, but I can rebuild them somewhere else.
But that's not, you have built a new factory. You've not reversed the climate risk event. Do you know what I mean? So we'll come to that. There's the, how you can, there's prevention, and then there's preparedness for the risk. So if a counterparty defaults because its cash flow is not right or whatever, and it's default, you can go and you look at their operations, you restructure the operations. You can't go and change the fact that this area is prone to flood, and therefore whatever you have there, flood might damage it again. What you can do is do something to prevent, when the flood happens, that it protects your asset. That's what I mean by irreversible.
Yeah, so, and this is an open question. I don't have the
As I
answer,
said,
but
yeah.
is it the case that it's, do we know for a fact that things are not reversible? So if we, I don't mean to.
Well, I'm no geophysicist. Maybe, I don't know, Lars is here or somebody else can answer that. But, he's talked more to the geophysicists than I have. But when I've talked to people about this, because, as I said, you've got to go out and talk to a lot of people on this topic because nobody's got the answer. The way that I get that the climate risk is it's not reversible. What we can all do is do things that will prevent it happening or slow it down or do something positive to the environment to reduce the global warming and things like this. I mean, I don't know whether you will agree with this, Lars, or not. I'm putting you on the spot a little bit here.
Geophysicists that they went across many centuries and stuff like this, and there can be changes over many centuries, but that's typically not the timescale economists care about. So.
Yeah.
It seems like the more important issue has to do with when the change happens, the adaptation question, and how good are we at adapting to it in order to, instead of imagining the climate reversing,
Yeah. So we'll talk about adapting financing in a minute. You'll see I will talk about this, which is exactly the point I'm making. You can adapt, but I don't think you can reverse.
Okay. I think the question maybe is
Yeah. And the interesting thing is in the conversation I had with Luigi as well yesterday is terminologies are very fluid in this topic because people use different words that may mean different things but might mean the same thing because it's not an established framework, it's not an established risk types yet. So many banks, when you go to if you ask, I don't know one bank that today has their risk management framework usually lists what are their top risks in their bank, right? Traditionally, you will see market risk, credit risk, operational risk, cyber risk, compliance risk. There's about 10 of them, models risk. But climate risk is not there. But this year, climate risk, well, I know that in my bank, I have put climate risk as one of the top risks in our risk management framework. By next year, I think most banks, don't know about the US banks, but most banks in Europe will have it as a risk type, which means this framework that I'm sort of talking about, which is still quite, it's evolving at the moment, will have to become much more precise. And in last week, for example, the governor of the Bank of England has come out saying, banks, you've got 2 years to put a framework completely in place. And framework means how do you manage, how do you quantify, how do you monitor, how do you take actions? Very difficult, I think. I don't think we'll have answers in 2 years.
If I can just have one thing. It seems like there's this transition risk category is carrying a lot of weight. There's a lot of stuff that's in there. Regulatory risk. I have a list in my head. Reputational risk. Credit risk. I mean, it seems like a lot of things can go into transition.
That's the interconnectedness. Absolutely. We'll come to it in the next page, actually. When we talk about the definition a bit more in detail. Okay, let me just go to the... Okay, so the two big the two buckets in climate risks is, and that is not my definition, by the way, that's what's out there, is physical risk and transition risk, okay? And maybe what I said before, that in my mind climate risk is the interconnectedness is very important. And I don't know whether, you guys will all study economics, and obviously people like Luigi will agree with me, but I say that one of the terminologies I've used is that climate risk is really like a circular economy. It just touches everything, and if you start to look at where climate risk could start and where it ends, it's the complete value chain of an economic cycle, of a bank, of a production plant, of whatever. And we'll go into the details in a second. Okay. So physical risk obviously is you guys will understand that it's pretty straightforward. It's basically natural hazards that includes floods, hurricanes, sea level rises. And for me, the impact of physical risk, let's say now I'm talking about as if I'm a bank, but it doesn't matter. It would be the same if I was a car manufacturer or whatever. I need to look at inwardly and as well as outwardly. What I mean about inwardly is how do I, meaning my own buildings, plants, data centers that provide the technology support, which is critical, disruption to value chain, to supply chain. How am I exposed to this? So, for example, if I am a bank and I really rely on all my data centers that are all being outsourced, and they are sitting somewhere that are prone to hurricanes, floods, does that present a risk for me? Are my buildings, so if I'm a Japanese company and I've got lots of my buildings are in earthquake prone areas, have I thought about this? These type of things, okay? And outwardly, obviously, is you look at your portfolio, you look at your clients, what risks exist within those portfolio, to these clients. So, if, for example, if I'm a bank, I'm lending to a production plant. Where is that to a company that has multiple production plants? Where are the production plants? Where is my collateral sitting? Have I got that sort of risk? Who do they sell to? If I've got again the same example of a production company, who do they sell to? Where do they source material from? This is the indirect. Now, the thing is that it could be infinite, and that's my circular economy type comment that I said before. And when I've sat down and talked to business people, they sort of look at me and they said, "My God, this is never ending." We already had credit risk where you are asking us a million things to sort of like cover to get a deal done. If I start looking at these type of risks, it will never end. And again, it's the balance, okay? So I'm telling you about, at the moment, trying to figure out this framework where you start right from the beginning, and I'm sure that, of course, we will pair it into a reasonable level, but it's actually quite interesting when you start thinking about it in terms of where, the intellectual challenge of thinking, where does climate risk actually hit entities? And then if we go to the transition risks, so I've laid out here what I think falls into transition risk, okay? And transition risk, to put it simply, is the risk from the process of adjusting to a low carbon economy. That's the way at least, it's not, again, not my sentence, that's the way the Bank of England has referred to it when it passed its guideline requirements about 6 months ago. And so I sat back and I thought, okay, how am I going to look at transition risk? And what I thought about was 3 buckets. One is the governmental or policy action, as we were just mentioning earlier on. Then the technology, i.e., for example, carbon storage. And 3, societal preference. And I think that is actually quite critical, and I'd be very interested to hear your views, because I think that the younger generation thinks about climate change far more than, for sure, my generation does. The younger generation are making choices around traveling. Obviously, all young people want to travel. But I read a research paper recently where the aviation industry is actually predicting something like 2% drop in revenues, because they believe that their client base from the newer the younger, population is starting to drop and will continue to drop because of preference around climate decisions. And choice of electric cars. They may not have a choice anymore in a couple of years, but they are thinking about, if I need to buy a car, I'm not going to buy a petrol car. I'd rather buy an electric car. So can I just stop here a minute before we go into the sort of maybe more detailed discussion around the transition risk? What do you think about these three buckets? Do you think I've got it about right, or do you have any other views?
I'm very curious. It sounds to me. It sounds to me that different companies or industries are exposed to different levels of risks. Have you looked into, which sectors or industries are exposed, more risks than others? And on top of that, have you seen a trend that the sectors which are exposed with more risks are investing more in their ESG divisions?
Yeah, no, absolutely. So that's the first thing we did. So when we started to look at the climate risk, is because, the view is that it is very circular and it touches everybody. You can't start looking at everything because you'll never sort of hone in on to something specific. So we started to think about exactly that. Which are the industries that are mostly exposed, or more exposed, I should say, to CO2 emission, or to potentially events that arise from climate risk. So obviously oil and gas is an obvious one. Metals mining, the aviation financing. So the bank that I work for has a very big division where we actually do a operational lease of aircraft, and we buy aircraft and lease them to Singapore Airlines, Qatar Airways, American Airlines, British Airways. So they don't own the planes. We own the plane. We lease to them. And so we've looked at all of this, and what we're trying to figure out now is that, so how do you take those industries and you try to put a climate rating on the individual counterparties that will feed into their potential probability of default, on top of your normal financial cash flows and so on that you would be looking at. So absolutely. And slowly, I think over time, banks will address the top industries first, the most obvious ones, and then go further. But yes. Do you think that the three buckets that I talk about, what do you think about this societal preference? I mean, I'm really interested in your views, given, I have to tell you, on a Saturday evening one day, my son, who's 20 years old, started to talk to me about climate change and what were we doing about it. And I thought, when I was, his age, I probably didn't want to talk about climate change to my parents. I wanted to go out and go to the nightclub and not have a discussion about climate change. And we asked him, my husband and I asked him that question, and he said, no, it's a very important topic amongst in their house. Anyway.
So from a specific regulatory changes or physical risks, I kind of understand the direct bucketing. I'm curious, when we get down to things that should show up in other risk metrics or predictive metrics, if you're trying to forecast demand for airlines, presumably changing youth preferences for flying would show up in traditional demand forecasting for airlines, or how you think about demand forecasting for airlines. Do you worry that there's sort of a double counting effect where it might show up in surveys or research on what young people want, whether they want to fly, and then it's going to show up again when you stick a climate number on top of the whole model?
Yeah, so really, really good point, and an important point, because what the regulators are actually at the moment saying is to say, you've got these climate risks that are coming, and we want you to hold capital against that. You probably have been thinking about it before. So let's take the airline companies, what you just asked. So we obviously are looking already at financial airline companies to say what is impacting their level of transport customers. You sort of stress this forward on certain level, and based on that you take a view already on where your credit default probability of default rating is. So if on top of that, you then say, because you've already taken into account that their revenues are going down. So if on top of that you are saying then I will add something because climate might impact these revenues level and penalize again, that would be wrong. You will have to make sure that in your modeling that you have actually married the two. And I think that this is one of the biggest challenges. I've not figured out or even thought about how to tackle this, is how you will bring these two together, the fact that you take this climate event and bring it into a financial rating and a financial impact that you are not double counting. Because if we then said, there's a probability of default of the counterparty, I've already taken into account that it's cash flow for various reasons, management themselves are predicting the cash flows reducing, then I'm going to impact it again because I've done my climate analysis. That would be wrong. My view is that banks need to sit down together and try to figure out, I mean, there's lots of banks, so I'm not saying that everybody gets together, but for example, in the UK, I'm talking to the regulator and saying, allow the 7 banks in the UK, the 7 big banks, to form a group together and figure out how to come up with that framework, because otherwise you will have banks who have there will be no common base of how people are accounting for this. Some might be double counting, some might not be double counting. I think this is one of the questions to answer. I don't have that answer yet, I have to be honest. But absolutely something to think about.
Seems like another important distinction here is between risks for which risk management frameworks already exist versus those that are unprecedented. Like if you're if you provide insurance to farmers, you already have some framework for accounting for the risk of a crop failure. And climate change just means that the probability of crop failure in certain regions is going to change over time. But for other things like sea level rise, we've just never seen that before, and I'm not sure what kind of, you need to develop a new framework for that kind of thing.
Yeah, so that is absolutely right, and I'm going to come to this. I'm going to forward the page for a minute. So this is basically just a picture, if you want, a schema of what we've talked about in terms of thinking about risks. And by the way, climate for me also brings a huge amount of opportunities. So when I talk to my business colleagues at the bank, I tell them, yes, think about the risk, but think as well about the opportunities. And the opportunities, before I answer your question in a second, sorry, I'm just trying to make sure my when I think about the opportunities, so you guys would have all heard about green financing. Obviously, everybody's doing green financing. There's you get various capital breaks for doing green financing. I don't think that the opportunities are as big in green financing as they are on adaptive financing. To answer the young lady's question of earlier on, is when you provide adaptive financing, so which means mitigating the impact of physical risks. For example, I don't know if you guys have read about the city of New York, who has come out with something that says, we know that we're at high risk of flooding in the future. We don't quite know when it is. We're going to have to think about how do we build defenses for when that flood comes. There will be needs for financing. We work a lot, my bank, we work a lot with Hong Kong and Singapore. The government has formally sent out research papers that they had commissioned on their risks to rising sea levels, and in the case of Hong Kong, typhoons as well, but in terms of rising sea levels and in terms of what defenses they want to try and think about, and they're going to be launching projects for banks to bid on for financing. So I think opportunities are there too. But I'm going to come to your question of the different risk types and how to think about it, okay? So let's take a look at this for a minute, okay? Think about this. So you're a bank. You've got a counterparty that's a European manufacturer and seller of vehicles. They're in 123, they have 123 production plants in 31 countries. They sell in 153 countries. They've got a major refresh of strategy to basically decarbonize with a decarbonization program, new electric car models over the next 10 years, and so on. The market cap is very large. This is a real company, okay? And I'm sure you can figure out just by the background. I just didn't want to put names there. They've got very high revenues. Rachel, my screen is gone. Revenues and income. They've got quite a lot of investments going in every year, and they're asking you to, for a 1 billion lending facility and a currency hedge, right? So now you're the risk manager, and you're being asked, forget about the other risks, which is credit risk, default risk, the normal type of things. What would be the key climate risk considerations that you would think of when you're looking at this this proposal? So what do you think? This will answer your question, okay? What do you think? So physical risk. What if you think, okay, let me think the two buckets we talked about. What would be the physical risks you would think about? Don't be shy. What would you look at? They're a car manufacturer. What are they doing? They've got all these production plants in 31 countries.
One of them would be, are there any bottlenecks in the supply chains in the vulnerable places relative to climate events? So the big example is, I think, Toyota in Japan, where there was a small detail and then the whole production stopped. It was like in the 90s or something.
Mm-hmm. Very true. So yes, you would look at where would their manufacturing plants be? Are they close to hurricane? Are they in hurricane-prone zones? Disruption in production, in the supply chain, as you've just mentioned. And, even if they are diversified, by the way, this will solve or address probably operational risk, and it comes to the how do you bring in the other type of risk that have defined risk frameworks. But the diversification might not work, might not give you any benefit if, depending on which areas of that climate event, if you want, are being impacted. So I think it's actually quite a little bit complicated. So, for example, as well, what form of shipping do they use? Do they put their cars on big ships that are crossing areas that have got hurricanes or whatever? I don't know, but all of this you sort of think of, and obviously it could be endless, but you can't just go endless. This is my big problem with that. Is I sit down with two or three of my team, and you come up with such a list, and then you just got to bring your thoughts back, because you could come up with so many permutations, and you just got to try and make the best judgment and assumptions. But the physical risk that these guys also run is also their own suppliers. Where are their spare parts coming from? What are these guys exposed to? Most car manufacturers don't, they all have spare parts coming from all over the world, in particular from places like Asia, who have quite a lot of issues around physical risk exposure. And on the transition risk, thinking about the three buckets. So the way that I looked at this, and this was a real example, by the way, that we took to our board to get them to understand how we were looking at climate risk. And thinking about the three buckets that we talked about earlier on. So if you think about the industry in Europe, the car industry in Europe, I think has taken something like 27 billion in the last 4 years of fines around rigged emission tests. So how do you, and as it happens, this is not the company that has been the most exposed to, but how do you factor something like this in that, it's, again, you have to make a judgment, but I think it's not so straightforward. When we look at this refresh strategy, what is it that, let me just bring you the next page, actually. So does the proposal align to the business strategy? So what do we mean by the strategy? What would we think there? They've said that they've got a refreshed strategy. What do you think you would think about looking at them? I mean, I sat with these guys and I asked them, how are you thinking about your, where your plants are, where your cars are? What is the level of electric cars that you're going to have? You guys might correct me, but I know in Europe at least, I think that the level of electric vehicles on average in car manufacturing companies, I think it's less than 5% for electric cars and less than 10% for hybrid cars. And we want to hit, carbon neutral in 2050 as a globe. I mean, that number needs to be, without having the precise maths, it has to be at least 50% of car production will have to be hybrid or electric. I think it's very tough for that to happen. But in any case, you got to try and, I sat with this company and said to them, how are you thinking about this? You've got this revised strategy. Where is your investment going to come from? How are you thinking about your physical risks, your transition risk, your liability and litigation risk, not just for rigged emission, but if policy is coming in, how are you doing it? Your reputational risks. What reputation risk might you face if the world, the preference of society is to go more for electric cars, but you're not producing electric cars? What brand do you want to have? Do you think when you look at a company like this and they're asking you for money, that the purpose and the tenor should be a consideration? Do you think that you should, if you have a climate risk hat on, do you think that tenor should be a consideration, a 1-year facility compared to a 5-year facility? I think tenor is important. So again, there's a different thought when I talk to my business colleagues about this, because they say, why do you think about tenor? You don't know anyway what's going to happen. But I think physical risk maybe in the short term might not be such a big risk. Although again, you don't need a lot of scenario analysis around it. But the long-term planning, I think you do need a lot of different type of scenario to look at. Again, the different scenarios are going to be very subjective. They're going to be very, you're going to have to make judgments and take a decision between 2 or 3 different outcomes that you may have. Personally, I think it's very tough. I want to go into. I'm not going to ask you questions on this, but I'm just going to very quickly say to you, I looked at another. We were asked to look at a bank, one of our counterparties who was very heavily involved in the mortgage business, and you can see there, New York, Connecticut, Massachusetts, and so on, where their mortgages were. They had high net worth clients from the U.S. in particular, that they had financed their second and sometimes third vacation homes, and they also had quite a bit of REITs, which are the real estate investment trusts, on their books, mostly borrowing in dollars. Average loan to value is pretty good. And I was asked to, take a look at this and tell me what do you think are, what should we be concerned about if we had to start applying a climate lens? And the interesting thing is obviously the normal one, again, coming to how do the other risk frameworks come in, the default of the counterparty, the loan to value, and all this was actually quite good. But from a climate risk perspective, what was interesting when we started to look at this was that I read a report, I had read a report by a non-profit entity. I think the name is Union of concerned scientists or something like this that had written something about what they thought was a chronic risk of flooding in more than 100,000 coastal homes in the U.S. And the collective value of those homes, they estimated was about $52 billion. And it outlined that there were about 14 states in the U.S. that by 2030 would face quite a lot of damages because of sea level rises, and these included, the worst one actually was I think it was California, if I'm not, no, it can't be, it's Carolina. Anyway, quite a lot of them. Massachusetts at about 2 billion, New York at about 2 billion, actually, no, it was California, 10 billion it was, I think. I mean, really large numbers, 10.4 billion in New Jersey. So if you think about these guys where their portfolio was, there's a high risk of the collateral that you've taken, even though you've got a decent loan to value, that these goes away. They then had these REIT that were mostly invested in Hong Kong. If you look at the performance of real estate trusts in Hong Kong, they've actually performed really well over the last recent years. But Hong Kong is the most overvalued real estate market in the world. And 35% of REITs in Hong Kong are exposed to this climate risk of flooding. When they looked at the individual, there was a report that was done for our board. We looked at the different parts of climate events that could happen. It was from areas that were exposed to flooding to areas that were exposed to maybe typhoons. It was actually quite interesting. We look at insurance companies. I can show you other examples of insurance companies. Somebody mentioned insurance earlier on. They have this data. The key differentiating point for me is that we know this risk. We've already looked at these risks when we've assessed the credit risk. What we now have to do is put capital against those specific risks, which is something banks have not done so far. And how do you calculate that capital that you're going to put aside? So it's very prescribed for credit risk. If you're dealing with a corporate, which is a large corporate, and you're doing this type of exposure or product, the regulators tell you need to hold X% of capital against that, and depending on where your model has been calibrated and approved. They're asking you now to do the same for climate. I don't have the answer to this, by the way. I'm just trying to say that when you think about these type of risks, and we're now being told, put some capital against this, and you think about this concerned scientist report who says that there's a potential value of 52 billion worth of real estate that could actually be impacted by 2030. What should banks do with this? How do they calculate the capital that should go against that? Sure.
How do the banking regulators think about this? For example, Basel, are they also requiring banks to set capital aside?
Yeah. So it's a beautiful question because they don't know, and they will tell you they don't know. What they are doing is they're asking all banks to give their views, to give their. I mean, there's another. I think it will be the third consultative paper that will come out for the PRA, but there's also one that's going to come out from the EBA. And they're asking banks to say, this is the exam question, how do you deal with it? And they're asking all the individual banks, and they want to see how banks are responding. At the Bank of England, they have created working groups, if you want. So I'm on the working group for the risk management part. I mean, there's groups that are specifically looking at the business risk of transition risk, the business risk of physical risk, but they don't know, and they are very honest at saying we don't have the answers either. And I think that is one of the challenges. I talked about the high net worth individuals. This bank, most of the real estate is sitting in the Caribbean. And there is also the report from the concerned scientist that says, actually no, this is from NASA, that said the sea level should increase by 4 feet by 2100 in the Caribbean. That will, in fact, impact so many coastal communities, in particular the Bahamas, Trinidad, Tobago. And we looked at where did these houses were sitting, and quite a few were sitting in some of these countries, and then other countries too. But we had quite a few in those 3 countries I just mentioned. And the report also said that in Latin America and the Caribbean, about 32 million people, they believe, will be affected by the sea level rise because they live in areas that are 10 feet above sea level. And the losses there range anything up to $1 billion in the 22 largest cities in the Caribbean, and Latin America. So it's big numbers, big potential losses.
Hi, I was wondering how much of this risk could be simplified or quantified with a carbon tax? Or
Can you speak up a little bit? I don't hear.
How much of this risk could be simplified or easily quantified by a carbon tax?
By a carbon tax.
Yeah, I mean, but how would the carbon tax? How would the carbon tax help you in? I'm just thinking out loud, okay? Help you in quantifying the capital that you need to hold against such risks.
Like, for example, let's think about reputational risk. So, I mean, if you're paying tax, you're paying the social costs. So, you should be insured against that. At least for the technological risk, it could incentivize technology which would be less carbon.
Yeah. So I think if you ask me the question, will carbon tax help counterparties think about their climate events that we as lenders would be exposed to? Absolutely right. And maybe you've just given me an idea, actually, which is quite good. Carbon tax is not there everywhere yet, but we can see it coming more and more. Whether looking at the level of carbon taxes that counterparties are paying or subject to can also be that's a good idea. And to come into the risk metrics. Yeah, thank you. So as you see, it's actually quite broad. So I'm just going to go very quickly to this one. Okay, we don't have a lot of time, and I'm not going to go into the details. But you guys would know this far better than me because you're in the US, and I'm sure that you've followed what's going on with Pacific Gas and Electric Company in California. And for me, I look at this and I use this. Things have moved on even from when I did those slides. I use this as an example when I went to the board of the bank I work for, because I think that this might be the first case of climate-related bankruptcy, climate risk-related bankruptcy, and what has happened. And, if we look at the risk assessment, if somebody sat back and thought about what risk does this company have, and if you look at the buckets that we talked about in climate risk, and you broke it down, physical risk, credit risk, litigation, and so on, with a climate hat on, I think some of what has happened to this company actually, could have been foreseen. And this is a company that had something like, I think, 35 renewable projects on the go. So it appeared to be a company that was very involved in thinking about climate events. But if you looked at its track record going back, I think to 2000 was the first time that it started. We can go back to 2000 when it had some big disasters already happening. So I think it is quite... if you take that framework, and as I said, I don't know whether this framework is going to go through where I work, but that's how we are approaching it. So I don't know whether this provokes for you some level of thinking, or like, how do we think about climate risk? And people, I've found the people who work for me, I've said to them, don't say climate change anymore. You need to say climate risk. Climate change guys are sitting in corporate responsibility. They're not sitting in risk management. We've got to say risk management, so climate risk. And if we sit back and think about those buckets, I think we get to an answer, but I'm struggling with how am I going to quantify that risk? How am I going to develop a model that will give me the risk factor of climate? I don't know. Yeah? I'm going to leave you with...
Could I actually ask another question?
Sure. 1 second.
Yeah.
Let the lady go first.
So what I find a bit of a contrasting trend is that we said yesterday, so this risk comes on top of all the other risks that were already existing before, right? And we talked about that the key point is pricing the risk properly. So it seems like if these risks are affecting all sectors, some more, some less, prices will go up across the board, right? So I see the tendency of the clients having higher volatility in cash flows, losing properties, losing assets, and at the same time being asked higher prices to pay for their insurance or increase risk premium and insurance premium. So how do you see, it seems like these trends, the client and the banks are going into separate directions.
And you know what, so we have constant conversation with, because I work for the UK Bank, obviously that's why I refer to the Bank of England quite a lot, but the point that the Bank of England is the most concerned about is that exactly what you just said in terms of pricing of the assets. They're very concerned that because of the way people are going to try and look at this risk, that for the same assets are going to have different pricing depending on which bank it is. And I mean, obviously, banks have different risk assessments. Even a bank might not have the same rating for the same counterparty as we do, but essentially the risk framework that are in place from regulators implies that you will have the same sort of level of capital that you're required to ask for a like-for-like counterparty. I think this is my point about trying to get banks together rather than allowing banks to do whatever it is that they think is right, like everybody develops their own models, because I think it could have a big impact on pricing. Because if you are having to hold more capital against a risk type, or you're double counting when you should not be double counting, it will impact pricing. And as we've been talking about the last 2 sessions, pricing obviously drives quite a lot, right?
Question
I completely agree.
They will be able to pay these higher prices if their assets are impacted more.
Well, they will have to, or you will lose the business, or you will impact, there will be the knock-on impact, right? Absolutely. Okay. So, as I said to you, I don't have answers to all answers. I've just showed you how I've gone to think about it. And, I work a lot in London. I work with one of the research professors that is being funded by the European Union on financial risks that are coming from climate. I do a lot of work with him to try and figure this out. I don't know if you've seen recently, but Columbia University, together with one of the big fund managers here, have just launched a specific course on how to assess climate risk, and they've insisted that all of their business people go and take that course. It's mandatory. So obviously it's a big topic, and I'm working with Imperial College actually in London to see whether we can come up with such a course for people in the UK. But I am very interested in people's views, and as you go through your studies and what you're doing, as I said, you can get my email from Rachel. I'm very interested in your input. If you think about something that you think, your carbon tax example we look at carbon tax, of course, but to think about it in a reverse way, I think, is something that I've not thought about. And I think it's quite interesting to take a look at this. And if you have any thoughts, I would be really interested in getting your views, because I don't have all the answers, and I don't think anybody's got all the answers. So any other last comments from anybody? Any questions, observations?
quick remark. I wonder whether you have thought from a stakeholder position and whether stakeholders are really serious about climate risks, because climate events are sort of a black swan. The probability is really low, and like the probability of the event in terms of lifespan of the bank is seizable, but the probability of the event in the terms of the tenure of a particular CEO is very low, and they are mostly act on the paradigm of shareholder value. And there is different approaches like shareholder welfare and other considerations, but whether they should actually, how the change in the way of thinking of the management on what the maximization value should be of the company actually affects the assessment of the climate risk.
Yeah, I think that's very important because in terms of the company, like if I think about my bank, the tone has to come from that top management for a start, but also the board. This year we have done a lot of training for them on what this means and what it is, and their key question as well is coming from the fact that, and I think the Bank of England is unique in that the Bank of England is pushing for this financial risk to be recognized and capital to be calculated and so on, right? And therefore they're having to do it. But the interesting thing is I spent some time with BlackRock, and they talk about this online, and I think it was last year or the year before, it must be, their CEO came out to say publicly, he said, environmental issues, climate issues, very, very important to us. It's a core value that we have. And they have developed this tool, and I've seen the tool. It's not completely perfected yet, but I've seen the tool in the work that I've done with them, where they are assessing all the big companies that are listed in the major markets and what is their value, if you want, from a climate perspective. Do they care about climate, including banks, by the way, right? The banks, they look at what their disclosures are and what they are saying they're doing about climate event. And they are giving this to their investors on a weekly basis, how, from an equity investor perspective, which are the companies that are at the top of the spectrum if you want to think about climate. And it's something that investors, I think, are really caring about these days. I was at our annual general meeting this year, and I was quite surprised at the number of questions that came up in terms of, well, you're a big commodity financing bank, and we do because we work in EM, so there's a lot of commodities-based business there. What are you doing about it? How are you going to tackle this? So I think it is very important, but in Europe, for sure, it's coming. I don't know about the States, okay? Obviously, given the stance that the authorities have on climate. The couple of banks that I talk to people at Citibank, JP Morgan, Bank of America. I know that they are paying attention to it. I don't know if they are being forced to do as much as the banks in the UK or Europe are having to do. But you are right, it has to come from shareholder. And senior management, the board, basically.
So thank you very much.
Thank you.